Hey, Michael Hopkins here from Seeking Alpha again with Jennifer Warren at Concept Elemental. So let's just start with the first question. You're in Dallas there, and it's pretty warm, I guess.
Oh, it's awful. Last night it was 114. It feels like temperature at like 8 p.m. I thought, oh, I'll walk. The sun's gonna set. I stepped outside and stepped right back in. Even this morning it was like 81 at like before 7 a.m. And even the dogs are unhappy. It's just insanely hot and miserable. I just hope that ERCOT, is going to be okay. Our grid.
Right. Yeah.
So
So, I mean,
I'm not
again,
even looking.
we'll just segue from that. I mean, we're talking about warm temps, and that's going to put, like some demand on what we have for energy. So, since we talked last time, and now that we're talking again, and you have some slides to share, some updates to share, some overview thoughts, some things that have been going on lately within energy.
Yeah, I mean,
Oh, it's
you know,
lately.
there's in a way just kind of looking at fundamentals. Given all the AI day and all the excitement of the triple Q, and then some of the announcements with like Shell saying that they're going to kind of slim down on their green ambitions. And I think there's just a lot of, it's still this continued reset, post-pandemic reset. And I think the markets were a little bit reflective of that. It's kind of like a doldrums, like we're in the doldrums. And, there's still the expectation that there could be rising interest rates again. And there's sticky inflation. And the China factor with energy, the demand there is hard to gauge, although there's been talk of stimulus and all that. OPEC has said they're sticking to their guns with their cuts that they had said they were going to do. And just in a general way, I mean, there's still a lot of fossil fuel infrastructure in demand, being demanded, being built. There's some renewables. There's some gas replacing coal. However, on a global level, I just saw this chart in The Economist yesterday, and in fact, coal is not decreasing around the globe in other places. So that's not a great thing for carbon emissions, right? Which is the argument for more natural gas is that, and in the United States, I'll show you a slide about how that looks. And then on the decarbonization front, just that we're going to need some tech assist from that to get us more efficient. And again, the IRA legislation helps focus the minds. But I can start sharing if you'd like.
Sure.
um,
Yeah.
so and the other thing too is oil demand is set to increase. There was some analysis of a 5-year forecast from the IEA, which is the Paris-based energy watchdog. And the demand growth is slower, but they said it's still growing, but the internal combustion engine's efficiency is also helping slow demand. And then EVs just at the margin. So it's really more of a, the classic cars engines becoming more efficient is kind of helping with that demand. We're at 102 million barrels a day in 2023, supposed to rise to 104 by 2028 in 5 years. So, and then if we're going to get to net zero in 2030, we'd have to be using 75 million barrels a day. So we're nowhere near that. Now I will start sharing. So this is just a shale map, and we've kind of looked at this one before, but I just kind of want to set the tone. So here's the Bakken and the Niobrara. Bakken up here in Montana, North Dakota, Niobrara, Colorado, Wyoming. The Marcellus over here, Pennsylvania, Utica, Ohio. And those are largely gas play. They're known for being gas plays. Haynesville, largely known for being a gas play. Eagleford, what kind of helped kick off the beginnings of the oil shale revolution, but it really took off in the Permian, which is over here unnamed on this chart, and then the Barnett Shale in North Texas, which is what really kicked off the shale gas boom. I don't know why this thing isn't supposed to, oh, there we are. And so this is just a look at sort of the projections of the EIA, which is the US energy watchdog. So predicted that Brent will increase next year. US crude oil production up very slightly. Natural gas spot prices in the US up. LNG exports up. And then here, this is kind of interesting, this share of electricity. We can see that natural gas, so coal stays the same. Natural gas, they're projecting to go down slightly, and renewables picks up that slack. Now, they're guesstimating that just based on, what they see in the pipeline, so to speak, but we'll see. But part of the emissions and CO2 emissions reduce a little bit. Part of that, it's not necessarily because of renewables. It is largely because of GDP declining, just meaning, reduced energy use in general. But so the combination of those two. So I don't know why these things are going the wrong way. Hang on, there's my. So this is world oil supply, and hang on, let me use both hands. Oops, holy smokes, I lost it. Okay, so right here you can see this tightness here towards the end of the year, and that is going to probably increase oil prices, which is expected. And this here shows you, here in 2023, there is not a lot of spare capacity. So that also, tells you what's highly likely in oil prices. This is looking at the basins that we were mentioning that we were going to look at. So this is oil production here on the left, and as you can see, the Permian. This is from last year to this year. As you can see in the Permian, we're at getting towards 6,000 barrels a day, 6 million barrels a day, call it that. Increasing. Niobrara about flat, Eagleford about flat, Bakken a little bit up, Anadarko a little bit up. Natural gas production, Appalachia a little bit up, Permian up, and that's also because of associated gas. Appalachia up a little bit, Haynesville up as well. And so as with the Niobrara, something I also read about, and here we have just marginal increase in oil, is that there's a lot of state legislation that could increase costs, which would drive up, the cost of producing there. That's a bit of a headwind. The Permian increasing because it's low cost, there's scale, all that. On the gas story, again, Permian increasing because of associated gas associated with oil production, Appalachia slightly up. And this is just showing it in a different way, where you can see, the number of wells that we're producing. And there's a lot of sort of flatness in all the other basins here. And the Permian's just kind of cruising along. This is the numbers looking at the production by region. And as you can see here, the Permian is increasing. Bakken, number 2 increase. Over on gas, the story is, the Permian again, kind of the lead in gas production because of the, associated gas. Haynesville, even more of a change than Appalachia. And that has to do somewhat also with the Gulf Coast, exports, LNG exports. And this is just looking at Texas, the rig count. You know, what's interesting here is, okay, 5.3 million barrels a day in March. And then the rig count was going down a little bit, but the production isn't going down that much. So it just speaks to some of that efficiency over time. You know, if you look here over on the far left, where the shale oil boom just kind of took off in the Permian, you know, we were down producing, you know, 2 million barrels a day. And look at where the rig count was, you know, and now, you know, here we are, you know, that's a lot of efficiency gain over time. And this is just looking at it again. This is a 3-month look of how it's changed in this is the Permian right here. And in fact, some of the rig count has gone down a little bit in some areas compared to the year look. So so there has been some recent change, and that's just, you know, reduced production, and that's getting back to that capital efficiency. Okay, so I'll stop sharing there. That's kind of the, you know, the color on, you know, what's happening and some of the projections. So did you have anything you wanted to
Yeah,
add?
so I mean, if we go back to some of those slides, some of that, you know, point bringing things out. We always talk about Permian, Marcellus, Bakken. When you look at these basins, what are the basins that are reflecting these notable trends that you're talking about? Like that, not just, you know, increases, decreases, but just when we talk about things like the transition, you know, where there might be, you know, the potential for opportunity or some challenges that might surface.
Yeah, I mean, I think it's all really a matter of cost, you know, and flows. The Permian, you know, low cost producer, all the energy infrastructure there connected to it. Haynesville's connected to the Gulf Coast, lots of energy infrastructure. There had been some constraints in the Marcellus, you know, Appalachia. But, you know, in my last video with Jay Hatfield, he talked about this new pipeline coming online that's supposed to ease some of that pressure. I haven't dug into that per se. He was just talking about, you know, he had this range of oil prices from 75 to 95. And, you know, that's probably about right. Because we just, you know, there looks like there's going to be tightness in general. And I mean, as far as the energy transition goes with our production, you know, and again, we can define energy transition as this transitioning state to decarbonizing the energy systems, how that looks. I'm not seeing a lot of, you know, there is all that solar deployment that we talked about last time, right? And so it's just incremental. It's very incremental. And I don't know how things are going to play out when you have some of these majors, you know, sort of pulling back out of their renewables investment, like BP, like Shell. Those are the European majors that have just finally started to kind of, you know, capitulate a little bit. And, you know, because of shareholder demands. And so you have, you know, some of the US majors that have been rewarded for, you know, just kind of being conservative about how they're shifting. And so from just the things I've seen in calls and things, you know, it's just kind of a steady trend. And that production, that increased to 106 million barrels a day in 5 years, that production has to come from somewhere. And there's going to be some call probably on OPEC, but also the United States, because, you know, we're one of the top producers in the world. So I just, you know, I think there's two transitions kind of going on, you know, in some respects. The transition with fossil fuels is, you know, trying to decarbonize more, trying to be more efficient with production, using tech to, you know, work out how to do that and scale more. Again, that could, you know, we could see M&A in the future, you know, so but I think with the interest rate situation too, I think it's just kind of a, you know, there's just kind of this doldrumy type feel that I feel, you know, so But I have
And I,
some, yeah, go ahead.
and I think that's interesting you bring that up because that second slide you presented, you show the connection between what happens with, I think it was especially natural gas development, or it may have been oil, but also connecting that to a decline in GDP. So
Mhm.
I just feel like there's these outside um, things that can impact and influence what happens in these markets.
Absolutely. Yeah. I mean, it's like when we talked about that, how BP did this analysis of the GDP hit because of the Ukraine war, how that looks, when GDP declines, there's less energy use, right? And so that's a potential tightening, because producers are going to respond to that. They're going to slow down, and that is what has been reflected some, I think, more recently in production in general. This kind of like slow go, see where we're at. They're not going to overproduce, and that is why OPEC cut. They want to keep a floor under price. Especially with this transition, with that uncertainty. you know it's just a different world. It's a world of cautiousness and constraint on producing those resources, I would say, in general. Did you have another question, or did you want to look at some of those stock slides?
One of the stock slides.
Okay.
Let's hear-
Let me just grab my notes. I have a lot going on over here. Ooh. Share again. Okay, so now this is kind of interesting. Okay, so this is like a 10-year look, and it's total return. I decided not to look at price. When you look at price, everything is really wacky, and this kind of really gives you a truer picture of performance in a way, because the stock market's just been sort of like really, really crazy since the pandemic. And so this is about 2013. This is the onset of the shale oil boom. And here, the top ones, look at this, Chesapeake, 118%. They're the purple line here. They've actually fared pretty well over 10 years. BP, under half of Chesapeake's performance. Pioneer up there. EQT, natural gas, hasn't done so well. A lot of volatility. CVX, also number 2 relative to Chesapeake. So that's kind of, and then Oxy down. Oxy's had a lot of up and down. And when we see this next slide, this is kind of telling too. So this is 10 years. This is like, watching it all happening here. Now, so this is 3 years. This right here is about the onset of the pandemic. And so this is energy again. And so really the EQT in 3 years, look at that, 188%. Pioneer, 160%. BP, 66%. That kind of gets at why BP, course corrected that very incident. Oxy, 200%. Now, nearly 200%. Now, what's interesting, because when we looked at Oxy at a 10-year look, it was a different story, right? Now, this, I think some of it is their low carbon ventures and discussion about, trying to have this decarbonization arm. But also you have the Warren Buffett effect. His support, I think, for that stock, kind of gave it a little bit of a boost, that I don't know that it would have had otherwise. But they do have really good assets. So, and he invests long term. I mean, he's, I vaguely remember in his call him saying that, he's looking out, well over 5 years, 10, 15 and longer. And then this is a 1-year look, and this is all Permian producers. And the time horizon is 1 year. And so it kind of captures, this was like roughly when the war in Ukraine started, right around here at this far left. And since then, we can see the returns, Exxon 20%. This is total return, COP almost 8%, FANG lower, CVX 5%, Pioneer down. Pioneer, I suspect, has been a bit hammered of late because of, they had a dividend focus, and their stock price, kind of got a little bit hit compared to some that are having this combination, I think, of buybacks, and so the market obviously hasn't been really liking their story as much. And one thing to note, ExxonMobil, Pioneer, COP, CVX, these are all the top 5 producers in the Permian. So that's kind of interesting. And then this is like a 3-year look, and I threw in different stocks here. I threw in Triple Q, XLE, PXE is also an energy ETF, and actually I hold that one. And here's NVIDIA. So this is 3 years. Now, interesting, people may think, oh, the NVIDIA story just, really took off the last, right before Memorial Weekend, which we have here. But no, look, there was a really sharp increase here right at this point. And this was, March 2022. Right there is when the Ukraine war happened. And so you saw this decline in tech, and then it goes back up. And so it's really interesting to look at it from this point of view. Again, this is total return. Apple and their solid, Microsoft solid, XLE, PXE solid, Microsoft. But NVIDIA is really, I was really surprised by that, actually. Let me see what I've got next here. And this is just 1 year, again, with the same stocks, just for emphasis. But here I've added in my semiconductor ETF just to kind of see how it looks with some of these majors. CVX down 5% in a year's time. Exxon 11%, up 11%. AMSA is that MLP ETF, 8%. NVIDIA 162%. Triple Q 32%. S&P just cruising along, 16.5%. So that kind of, when you look at it in different time horizons, it really changes, and so you have to really, decide what type of investor you're going to be. And I'm not sure. I think this was when we looked at before. So, so yeah, I'll stop sharing there.
So what does all this mean for an outlook for energy? What is, long-term, short-term?
Well, I think the fundamentals are still there. I mean, if anything, the war in Ukraine has shown us is that stable energy sources matter, and we have to be able to power our economies, so that's the reason why the IEA, the Paris-based watchdog, even though they've been one of the top groups, that really parsed net zero, for the last 5 years at least, they're just kind of showing what reality is. And the reality is that oil production is growing still around the world. US LNG, as I showed you, is going to increase. Renewables are going to increase. It's all going to increase because there's growing energy demand. And when we talked a year ago, I believe it was like a 50% rise in global energy demand in general. And so that has to be met, somehow. And then if you add in the future demands of AI, cloud computing, all that those are energy hogs. Those are resource intensive things. And so, and a lot of these tech firms, want to be paired with clean energy. And so, I think that's a little bit of a constraining factor on some of that growth. Possibly, I feel like just in the last week, there's just a little more, like pause about the excitement of, I mean, the tech the tech story is there, and it's exciting, and I love talking about it and thinking about it. And we do have those supply chain changes. There's been all these new announcements with Intel, building chip plants in Europe, and that sort of thing. So so there's a lot of reshuffling and a lot of different opportunities, and I think a lot of our US tech firms are global, and so there's a lot of there's a lot of interesting movement on that front. But so are a lot of our majors, they're global, and I think you're seeing this, they're kind of getting more on the same page in some respect. It's been really interesting about the announcements between, BP and then Shell of late. And then at the same time, you have these other competing forces and voices, so it's a lot to navigate. And I just try to really stay focused on, the numbers and the sentiment and that sort of thing.
So it is interesting you bring up that pivot that Shell and BP made, especially Shell with the new CEO coming in. I think my takeaway from that is that US companies are pretty consistent going. I mean, they're just, I don't want to say they're slow and steady, but certainly this consistency, and I think you referred to this before, is it could be a plus for investors.
Oh, absolutely. I mean, Exxon, and I'm just as surprised as anybody. I mean, I've been watching this energy transition movie, since 2008. When Obama was president, and we had all these green hopes, and then we had shale rising, and then we had OPEC trying to take market share, shale crashing, ESG, 2016, 2017, 2018, kind of influencing investment, and then we have a pandemic, and then we have a war. And so it's just, and Exxon has just cruised along in a very steady fashion. Yeah, you're right. And so it's kind of remarkable. And I mean, they're just focusing on their competencies, right? And so they've been rewarded for that. I think COP is a little bit in that wheelhouse as well. And then they have a lot of Permian acreage as well, as does CVX. And they're global majors, and they have a responsibility to their shareholders, and they've been rewarded,
So let's go back to, I like a good map, the basins and stuff like that. How should investors look at these basins? Why look at these basins, and how to look at them from an investment perspective?
Sure. Well, I mean, I just look at the flows. I just look at the top line flows. And then what I would do is maybe see which producers are, the top producers, or which are hidden gems, that sort of thing. Like, for example, in the Niobrara, Oxy is active via Anadarko, CVX, Apache, Chesapeake. In the Permian, I showed those. In the Bakken, Hess, ExxonMobil. In Appalachia, EQT, big stalwart, gas producer. Chesapeake, AR, Antero, Katera. So those are just some names of some of the, known producers, and somebody can go and look at their investor presentations, compare those stocks, see what they're comfortable with, depending on their time horizon, and depending on, do they want a dividend stock, do they want a growth stock? I'm sort of more into total return, and I want something to generate good dividends, and except I don't expect that of my tech portfolio. That's my growth engine for the most part. So I look at my energy portfolio in a really practical way. It's kind of the engine that runs, and my steady engine. And I know there's volatility in it, but hence the dividends, you know.
Right. So just to wrap things up, I mean, a lot covered here. And then we also talk a lot about what's happening in Europe with the changes and stuff like that. Any thoughts on what happens globally? Any thoughts on the global context of all this?
Yeah, I mean, I think the big story is just that energy demand grows. LNG is more in demand, especially with what's happened with Russian gas. And those demand centers for the US are Asia and Europe. I think that, you know, we're going to see in time more LNG facilities coming online in the United States. So watching out for those players that, you know, play in that space. I like Jay Hatfield. I like large integrated midstream firms, just for diversification purposes. And I do like, you know, global majors, because so much of the demand is global. You know, I mean, energy is one of the most global markets that exists, and the US is a really good bet because we are a top producer, efficient producer, increasingly producing more cleanly, which is important. And so so to me, that's just, you know, that's sort of my recipe.
So maybe that's an opportunity here then. The only reason I bring it up is, you know, we all know natural gas is down, I think something 43% for the year. Could this be an opportunity? I mean, I don't want to say, you know, buy low and get into there, but it seems like.
Yeah, well, yeah, that is an opportunity to buy low, and we know that, you know, we're coming into the heat. You know, I mean, we're going to be burning a lot of air conditioning here soon, electricity and natural gas is, you know, base load, and so that's going to probably increase price. I mean, generally, as we saw with the EIA, they projected an increase in average natural gas prices in the United States. So yeah, if one was going to, you know, buy low, I mean, you know, it is an opportunity. I've had my plays for a while, and so I just ride out the storms. You know, it is, and something that Hatfield mentioned too in that last video is, you know, natural gas is very volatile, you know, and it's, you know, it's just, it's weather related. There's shoulder months. There's all those dynamics. So, you know, someone actually could go back and watch the Hatfield interview and kind of get some color on that as well.
But even looking long term, when we talk about this liquefied natural LNG, and it's not just US, I mean, this is opportunity globally for these companies as well, too, especially if we put more infrastructure in.
Right. No, definitely. And, you know, so, I mean, and that's why I invest in these. I mean, I'm looking out, you know, 5, 10, 15, 20 years because of the demand for natural gas. And I mean, India uses a lot of natural gas. China uses a lot of natural gas. I know China just signed a big 25-year deal with Qatar LNG. You know, I think that news was like in the last 24 hours even. So, you know, it's just indicative of the demand, and we will be producing a lot of that, you know, because we're one of the top natural gas producers in the world as well, and we have a lot of the energy infrastructure that supports that, you know, and we're trying to decarbonize, you know, we're trying to clean up all that production as well, so reduce methane emissions. And you know, so I think it gets to that idea of, you know, just cleaner barrels. And so I think the US has that competency that we are increasingly building, and it's only, you know, we're only going to get better at it, you know, because that's what we do. We innovate, you know. So.
Cool. Anything to add?
No, I think that's got it. I mean, don't get me started on AI, so we better stop. I've been experimenting. So anyway.
Oh, really?
Yeah. Yeah. I've been cloned and stuff like that. It's very interesting.
It should be like an AI generated video interview next time, right?
Yeah. Yeah. Uh-oh, don't get me started.
Well, I appreciate the time. Thanks again.
Yeah. Thank you. Thank you, Michael.